joining us on this month's the CEO update webinar. We've taken a very special opportunity with this one to expand our educational campaign addressing 1031 exchanges. We have a very special guest with Drew McCabe, and we'll turn it over to Kira here in just a second. A couple housekeeping items. There is a questions tab and a chat tab on your dashboards. Please feel free to use them at any time. During the presentation, we will be covering a lot of material, and if you have questions, by all means, please get them over to us, and we'll open it up for Q&A at the end of the webinar, and I'll be feeding those questions to our hosts today. Without further delay, I'd like to introduce Kira Golden, CEO of Direct Source Webinar, and I'll just leave it at that today. Kira, take it away.
Hi. Hey, guys. Good to be talking with you again this month. Thanks for joining us. Dave, thank you so much. Investors have requested for a while that we start doing these monthly educational opportunities, and Dave has really put in a lot of work to make them happen, so I want to acknowledge that. Thank him for that, bringing, curating such great speakers and partners that we use in the industry. So today, we're focusing specifically on a question we get a lot about investors who have 1031 money or are existing investors who've built successful portfolios. A lot of you guys have single-family portfolios or smaller multi-family portfolios. You've done well, you've been successful, and you're now ready to say, okay, I enjoyed that hands-on experience while I was doing it. It was fun. I learned a lot. I know what questions to ask. I know how to vet a good operator, and I'm done making toilets, or I'm done even handling calls from property management companies and dealing with that part of the process. I want to invest. I value real estate, but I'm ready to sort of take it to the next level. But I'm sitting holding this portfolio, and I don't want to give up the opportunities that are available for tax advantage growth of your portfolio through 1031 exchanges. So some of you on the webinar today know what a 1031 exchange is. Some of you may have done some already. Others of you might just be learning for the first time, and Drew's going to do a great job of walking you through, no matter where you are, sort of in your knowledge base, to learn something today. I'm going to speak briefly about one other option that we have and sort of how Direct Source Wealth can facilitate that 1031 process from what we do. And then I'll turn it over to Drew to dive into the details about how 1031s work and what's available for you. So there's two models that we have primarily right now. There's a little bit of background noise. If everyone can make sure to mute out.
Everyone is muted. It's one of our hosts.
Okay. Okay, it's gone. So the 1031 exchange, so there's two ways that we can help with that. Number one, we have a wholly owned model. So we have a number of investors who are saying, hey, I've got, $500,000 or $2 million or a couple $100,000, and I want to continue to hold my own real estate, but I want to be much more passive. And in that model, they basically just partner directly with us, with Direct Source Wealth, and we take down an asset, and we take the GP role, and they take the limited partner role. And that's very easy to use in a 1031 kind of example. Alternatively, there are investors who say, no, I really want to participate. I believe in the economy of scale that's generated by doing larger deals, the efficiency that's generated, and the strength that comes from that. And I really want to go ahead and move into an LP role in an LLC and participate in that structure. In which case, the 1031 exchange is not really an option, but we do have options available. So we do a lot of energy efficiency work on our properties, and that generates tax credits. And so what we do in that situation is we actually make those tax credits available to the investor so that when you sell your portfolio and move into a DSW co-investment structure, you can actually have those tax credits to offset the tax liability. So you're essentially moving into that new real estate deal with after-tax money but you're getting to keep your basis much higher and continue to grow your basis in a similar way to the advantages that are available for 1031 exchanges. So there are different options out there, and I share that just briefly so that people understand that, hey, don't just write it off and say, hey, I'm going to have to keep slugging it out and doing this work in order to get the most tax-advantaged situation. It's definitely something worth talking through with your rep to figure out if either a 1031 exchange in a fixed structure or in a wholly owned deal makes sense, or using tax credits to play with after-tax money, invest after-tax money. So that's about all I'm going to say today from the Direct Source Wealth position, other than if you guys have some specific questions at the end. And I'm going to turn it over to Drew McCabe. He and his father own 1031 exchange. I've personally dealt with them on a number of 1031 exchanges in my own portfolio. And I'll just give this example, although, Drew, don't hate me. I will couch this and say this is not how they probably prefer to do business, but I want to show you how exceptional their customer service is. I had a property I was selling. I was not planning to do a 1031 exchange. I needed to take that money out. I was going to lend it to a partner to make another investment. And the sale got delayed a few days, and yet the other closing was happening and couldn't get pushed back. And so we had to scramble and come up with the money for my friend's deal somewhere else, which meant now my project was available for a 1031 exchange, and I had about 2 days to get that all figured out. And I emailed Drew and his team, and by gosh, they pulled it all together. They made it happen. Again, not his preferable way of doing business. We encourage forethought, but I want you guys to know the level of customer service that we've experienced from them, because it's not only technical competence in our partners that's important, it's also that they share their dedication to their trade in making deals happen, and these guys have that, and they're the smartest I've come across in the business. So with that, I'll turn it over to Drew to explain how the 1031s work and what they offer, and then I'll be available for Q&A with Drew at the end. So Drew, it's all you.
Well, thank you very, very much, Kira. I appreciate that. And just so you know, you may have thought you were doing a last-minute deal, but the fastest one we've ever done was 21 minutes. We had somebody sitting at a closing table and call us up and decide to do an exchange. 2 days is more than enough time.
That makes me so much better. Thank you.
Yes, exactly. Well, first off, I'd just like to give a big thank you to Kira and to Dave and the DSW team, and also to Diana for behind the scenes for putting this all together. So a big thank you to you guys. I just want to touch on something that you had mentioned, Kira. And you kind of said, hey, we can either 1031 or look at this tax credit. And we'll get into this more in depth, but just kind of as a teaser, there's a way to marry the two of those together. And real briefly, it looks like something like this. Do a 1031 exchange from whatever asset into whatever new asset. Refinance that new asset, pull the cash out, and then go do a deal with DSW on the tax credit thing. And now you're taking you're taking non-taxable money out of the exchange that was deferred, pulling that out, putting it with you, getting tax credit. So it's kind of not one or the other. There's, if we're creative and really think through, and like you said, have forethought and planning, there's ways to make this all come together. So
love it. That's awesome.
We'll kind of dig into that more, but that's one way to kind of think beyond the box. So again, thank you for the introduction. My name is Drew McCabe. I am the president and CEO of Exchange Resource Group. I've personally been doing this for about 17 years. Kira had mentioned my dad, and my dad is in the business as well. He did his first exchange in 1977. This is actually our second go-around with the 1031 exchange company. We had a previous exchange company that we sold in 2006, and by the grace of God, sold at the peak of the market. So it was good timing or divine intervention, or a combination of the two. We then started this company back up in the trough, and to be honest with you, changes really weren't happening all that much. So we had other ventures that we were doing and kept the exchange business going, and then we saw what the market was doing in 12, 13, and really said, hey, there's going to be opportunity here, and started pushing forward again with Exchange Resource Group, or ERG. We're based
Drew,
in
this
Denver.
is Drew. Drew, I apologize for interrupting. Would it be possible for you to get a little bit closer to the microphone? We've got a couple of people chiming in that they're having a difficult time understanding you.
I apologize. I'm wearing a headset here, so I'll just hold it closer to my face.
Thank you.
Okay. So I'll finish up with this background, but saw what the market was doing. So we're based here in Denver, Colorado. We have offices in Dallas, Texas. We do a ton of stuff in Texas area, and another office in Florida. So those are our three primary markets, but we do them all across the nation. It doesn't matter where the property is located because 1031 exchange is a federal tax code. So with that, we're going to kind of jump into the webinar. Here are our objectives. Why would you use a 1031 exchange? We're going to learn the 6 requirements of a 1031 exchange. Identify requirements for selecting a QI. QI is a qualified intermediary, and that's what we are. We're going to recognize some common exchange problems and how to avoid them, and why 1031 exchange needs to be part of your investment and tax planning strategies. So here's what the section says, and you kind of read that for yourself. But basically what the 1031 exchange is taking a property that you've appreciated or that has appreciated, and instead of selling that property and recognizing a huge capital gain, you can defer that gain into the purchase of a new piece of investment real estate. Okay. The IRS says that must be held for productive use in trade, business, or investment purposes. So why would an investor use a 1031 exchange? We've just kind of got this simple graph here, just kind of comparing two different investors, and if they had equivalent properties and one paid tax and one decided to exchange, this little diagram just shows what would happen in the net effect of exchanging versus not exchanging. So you can see, and we just use real basic numbers. I will caveat with, we do not prepare your taxes. We can't tell you what your exact tax liability is going to be. We just use generalities. So we just use some general numbers here. 15% federal rate, 5% roughly for Colorado, so that gives you 20%. But basically it just goes down and shows you, investor A is not paying tax. He's deferring. Investor B decided to pay tax. They're going to, be much farther behind the ball at the end of the day. By year 20, you've got, $3.6 million worth of property versus $800,000 worth of property by 1031ing. And that, like I said, this is just a real basic illustration of the power of doing a 1031 exchange. So let's get into the 6 basic requirements, and these are laid out by the IRS. And these are what have to take place in order to qualify for a 1031 exchange. So number 1 is pretty simple, and the property you sell and the property you purchase must be held for investment purposes. So there's really only 2 categories of investors that are excluded from doing 1031 exchanges, and that's dealers and developers. So your fix and flip guys or your production home guys, they cannot use 1031 exchange because they're holding their properties for inventory or resale purposes. 1031 is strictly for long-term investors. So rental houses, apartment buildings, whatever your investment is, as long as you're holding it for an investment purpose, then it's going to qualify for a 1031 exchange. The code is not uber clear on how long you need to hold the property. It just says long-term investment. And so if you look at other tax codes and private letter rulings, we suggest a bare bones minimum of a year and a day in order to qualify to effectuate the 1031 exchange. The next,
Drew, I want to highlight that because that's
yes.
something that a lot of people, I get that question a lot, and there's a lot of misconceptions that it's a year and a day, it's some sort of requirement, and it's not. It's really intense, but the year and the day is there to kind of document the intent, right? That's the thinking behind that.
That's exactly it. So, for example, we've done exchanges on guys that have only owned properties for 3 or 4 months. Like, here's a perfect example. We had a guy who bought a duplex. His intent was to hold it long term. He actually had an email to his mom saying how excited he was that this was going to be his retirement, income. He was in the property, fixing it up, and a person walked in and said, hey, I just bought a property down the street, I'd like to buy this property from you. He said, hey, it's not for sale. And he basically offered the guy $100,000 more than he just paid for it 2 or 3 months ago. Guy called us up and said, hey, what do I do, you know, blah, blah, blah. And we said, we think there's an argument there that your intent was to hold the property for long-term investment, and somebody came along and made you a deal you just couldn't pass up. So he ended up doing another 1031 exchange, rolled into something else, got audited, and part of the reason they allowed the exchange was the email to the mom showing his intent. So as silly as that seems, that's, you know, you got proven to the Irish your intent. So thank you. And please interrupt me with questions or comments or anything. Love to.
So I just want to emphasize, as a mother, the main message to take away from that is that you want to be in constant communication with your mom.
Exactly. The 45-day identification rule, we'll dive into that as well. There's also called a 180-day rule, qualified intermediary requirements, title requirements, and reinvestment requirements for what we call our E4F rule. So the first one, held for investment purposes. Any property held for investment or income producing purposes can be exchanged for any other investment or income producing property. As we mentioned, as Kira mentioned, you own a portfolio of rental properties and you're tired of what we call TNT, tenants and toilets. You want to sell that portfolio off and you want to roll into a TIC structure with Kira. Then you're going to go buy 115 units down in Phoenix. Can certainly be done in the 1031 exchange realm. There's some planning and forethought, you know, setting that all up, but it certainly qualifies. You can sell a single family and go buy a duplex. You can sell a duplex and buy an office building, as long as you're holding it for investment purposes. Once again, forms of investment property: apartment buildings, single families, commercial, office, farmland, oil and gas. Here in Colorado, water rights are considered real estate. So if you've got a family farm that's got a bunch of water on it, you can sell that water off and roll that into an income-producing property. We do quite a bit of that here in Colorado. Water is like gold, and so oil and gas down in Texas. Once again, you could sell a single family and roll into oil and gas, or sell oil and gas and roll into a commercial building. So here's a real simple example. They owned a duplex. They bought in 2001, rented out to various tenants ever since. They want to sell it and go buy a beach house to rent out to others. Does this qualify for an exchange? It certainly does. So that's the first one, 45-day and identification rule. So from the day you sell your property, the actual closing date, the IRS says you have to abide by 2 rules. The first one is the 45-day identification rule. And what that says is you have to identify in writing to a qualified intermediary or somebody to a transaction to the party up to 3 properties that you'd like to purchase. If you want to identify more than 3, the IRS has a second set of rules called the 200% rule. And what that says is as soon as you identify more than 3, be it 4 or 400, the aggregate value of those properties cannot exceed 200% of what you sold for. So, in a real simple example, Dick and Jane sell their rental for $100,000, want to identify 2 or 3 replacement properties for $10 million each. Can they do that? Yes, they certainly can. Oops. Dick and Jane want to sell a property for $100,000, wants to identify 4 replacements at $75,000 a piece. Is this okay? No, because he's exceeding his free property, and he's exceeding his 200%. So after day 45, you then have a remaining 135 days for a total of 180 to complete your transaction, and that's called the 180-day rule. So you identify within the 45 days, you then have 135 days to complete your purchase. And those time frames, like we said, are set in stone. So it doesn't matter if it falls on Christmas or New Year's or Mom's birthday. Your 45 and 180 day rules The only time we've ever seen extensions are on huge natural disasters, Hurricane Katrina type stuff. They have given extensions for people, but that's very few and far between. Once again, the property must close within the 180 days. Pretty simple, and it must be one of the properties identified within the 45 days. The next rule, qualified intermediary. That's where we come into place. That's why we exist. The IRS was kind enough to create this rule, and companies like ours were born because of it. So when you sell the property, you are not allowed to touch the proceeds. If you sell a property and you don't have an exchange in place, the money goes to you, you have a taxable event. There's no way to unwind the transaction. That's why you have to have somebody like Exchange Resource Group to help you. So what we do is we prepare all the documentation that reflects that you're doing a 1031 exchange. We have to hold the proceeds on your behalf. So when that property sells, we have an instruction letter to the title company. The net proceeds come to us. What we use are segregated dual signature qualified escrow accounts. So your funds are held individually of everybody else. It's not a big pooled account like escrow company or title companies and things like that. So it goes into your exchange account, of which you are a signatory on that account. Now, different 1031 companies do it different ways. Some of them still use a pooled account. I would run the opposite direction if that's the mechanism that they're using. I would only use somebody that uses segregated dual signature accounts. The other thing about a QI is it must be an independent third party. So it cannot have a relationship with you as the client. So this is going to sound funny, but anybody you have a trusting relationship with cannot act as your QI. So your attorney, your CPA, your real estate agent cannot act in this capacity. Okay, sorry. So that's in that. Next rule is title requirement rule. The IRS says that the taxpayer that holds the old property must be the taxpayer that buys the new property. So therefore, if you own a property in your individual name, then you must buy the new property in your individual name. If you own it under an LLC, then the LLC needs to take title to the new property. Here's an example. Sue's the only one on title of the rental. Let's say she owned this property before her and Fred got married, and she wants to add Fred to the title right before doing the sale. Should she do it? The answer is no. And the reason being is because, once again, we go back to intent. Sue's owned this property for, let's just say, 5 years, and it's been rented out. She's reported it on the tax return. If she adds Fred a day before doing the sale, the IRS could potentially come in and say that Fred did not hold that property for the sufficient amount of time, and therefore doesn't qualify to do a 1031 exchange. So what we would advise Sue on is leave Fred off, complete the exchange in your individual name, and once you've bought your new property, quit claim Fred back on, or quit claim Fred on the title at that point in time, and then you're not creating a taxable event. Next rule is your reinvestment requirement or equal or up rule. This is the section where most people get hung up. What the IRS says is, in order to defer 100% of the gain in a 1031 exchange, you must buy a property equal or greater in value to the property you sell, less your closing costs. So, when you sell your relinquished property, at the end of the day, you take the cash proceeds that you have, plus if you paid off any debt, mortgage, you add those two together, and it equals your reinvestment goal. I don't know how many times a day I get a phone call that says, hey, I bought this property for $50,000. It's now worth $100,000. I want to do a 1031 exchange, and I've lined up another property for $50,000. And we explained to them, no, that's not how it works. This is what the IRS says, and their most common response is, but I only have $50,000 worth of gain, and I should only have to reinvest that $50,000 worth of gain. And the answer, unfortunately, is no, that's not how it works. The IRS has made these rules my opinion on why these rules exist is basically the IRS sees the 1031 exchange as basically an economic generator. You know, a lot of people argue, well, why does 1031 even exist? Why doesn't the other government just take their money, take their tax on the capital gains? And what you have to realize is when you do a 1031 exchange, you have a lot of people who are generating income and then paying income tax on that property. So if you imagine somebody just selling a rental property and not doing an exchange, you're going to have a real estate agent getting paid, the title company getting paid, most likely. When you do a 1031 exchange, you got to have somebody sell a property and go buy a new property. So now you've got a real estate agent getting paid on the sale, a title company, 1031 exchange company. On the buy, you have more real estate agents getting paid. You've got house inspectors getting paid. You have a lender getting paid. So that transaction generates huge volumes of income, and the IRS then gets to tax that. So that's my opinion. I can't. There's nothing in writing that shows that, but that's basically why I think they came up with the rule of you must buy a property for greater value for the property that you sell. Does anybody have any questions on that? That one can be a little tricky to understand. Okay. We'll go back through and just review these basics again. And Kira, you'll have to help me. If somebody asks a question, Dave, will you catch that, or how will that pop up?
I'm monitoring that, and we are open for questions on the chat bar and on the questions, so fire away.
While people are organizing their thoughts, Drew, how often do you find that a deal, either in the 45-day identification period, is getting near the end of the timeline, or on the closing period is getting near the end of the timeline, and the buyer is experiencing some stress or heartburn?
In today's market, quite a bit. That 45 days flies past.
Yeah.
And
so,
I
mean, I assume, oh, sorry, go ahead.
No, go ahead.
It's your floor.
No, please, I thought you were going to ask a question.
Oh, well, so what I was wondering was, we've been doing this kind of turnkey model, but it's pretty new, where we're putting properties under contract, and so we already have them basically tied up. So in their 45-day period, when they're identifying a property, is a much higher possibility. I mean, we could discover something in due diligence that kills the deal, but we will have done a lot of that before we go in. And I'm just wondering, from what you see all the time, if that's something that is a lot of value to investors.
Yeah, I mean, for sure. We have to be careful in our rule because we are, like I said, we're an independent third party. We cannot be in any relationship
right.
with you. So we have to really, push back to the client's, consultant. So, like, for example, for you, we would say, hey, call Kira and see what she has available. You can put it as your number one choice, number two, number three. It could be a backup for you.
Right.
We have a lot of people that do that type of structure that say, well, I kind of like to stay in single family, but the tax is too burdensome, so I need to make sure that I've got some backup. And that's where we see a lot of the TIC structure, tenant and common structure, come into play, where they're going to try their hardest to roll into another apartment building, but if they can't, they need to have a solid backup to roll into.
Okay.
So just we're going to just skim through here on the basics.
We got a couple of questions, if you don't mind. Both from Jim Reindell. Jim, relatively new client with us, but an old friend, so thanks for joining us today, Jim. So if I exchange up and get a loan on the new property, I could have extra tax-free cash, right?
Yeah, so let me explain that, Jim, a little bit better. So let's just use our simple example. We sell for $100,000. We have $50,000 in debt. So there's $50,000 in cash that comes into Jim's exchange account. In order for him to buy a new property, or in order for him to defer 100% of the gain, he has to buy a property at least $100,000 or greater. So let's just assume he goes out and finds a new single-family residence for $100,000. He gets a new loan for $50,000, and he puts his $50,000 in cash from the 1031 exchange and closes on that property. Okay, he can then go and do a refinance on that property, maybe a line of credit or whatever, and let's say take it up to 85, 90%. So he can potentially pull $40,000 out of that property, or $90,000 out of that property, and take that cash and go buy another property, go do a deal with you guys and get a tax credit with the solar panels and things like that. But once he closes the exchange, turning around and refinancing that property is completely legit, and what you do with that money is up to you.
Jim, I hope that answers your question. Please follow up if it doesn't. The next question is, if I'm selling multiple properties and exchange up to one, what are the complications with that structure?
That is a great question. And we are actually going to dive into that further down. We call that a consolidation exchange. And we'll kind of dive into that later on as part of the presentation. So if I could table that one. What was their name? We'll dive into that.
Okay.
So finishing up the review here. Number one, the property was held for investment purposes. So it's cheesy little PowerPoint stuff here. Number two, 45-day identification rule. Must identify your properties within 45 days. When you work with us, we provide you with that form. So we do all the documentation. We track that time frame for you. We send out reminders saying, hey, your 45 days is coming up, and we provide you with a form to do that. The 180-day rule. You've got to complete your transaction of one of the properties you identified within the 180-day rule. As a quick side note, you're more than welcome to close within the 45 days as well. We do a lot of what are called direct exchanges where they're selling on Monday and buying on Wednesday. That's certainly acceptable too. You do not have to wait the 45 days. I always suggest giving yourself a good buffer between your two closings, just because we all know how closings work and how they can have hiccups. But just so you know, you can do it within that 45 days as well. You must use a qualified intermediary. As Kira alluded to, talked about before, we really need to get in the process before you're ready to close on the property. So we always suggest, a week to 2 weeks before you actually have a closing, you need to get us involved so that we can get the documents put together. We can inform the title company of the changes that need to happen on the settlement statement, etc. And again, if you do not have an exchange in place at the time of closing, if you close and the money touches your hands, you're going to be out of luck. Title requirements. Making sure however you hold title, the taxpayer that owns the old property is the taxpayer that buys the new property, and the reinvestment E-Clor rule. We talk about the role of the QI. I've just kind of touched on it just right there, but we'll go through it. Who can serve as a QI? A QI is not a licensed practitioner, so really anybody can be a qualified intermediary. They just need the experience, obviously, and the know-how. Here in our office, as I mentioned, Dan did his first exchange in 1977. He's an attorney. My background is in finance, real estate investing. Scott in my office has his law degree. Dave in our Florida office is an LLM in taxation. Luann in our Dallas office has been in the title business. So we really cover the real estate transaction pretty thoroughly from our expertise. So the functions of the QI: prepare the paperwork, consult with you, walk you through the transaction, help you understand all the rules, hold the funds, and like I said, the consulting. We talked about this a little earlier as well. Make sure that whoever you use, if you don't use us, make sure they use a qualified escrow account. Not to be a doomsdayer, but there were previous bad players where money disappeared in 1031 exchanges, just like title companies, just like a lot of things. But this is one way to protect against that. Make sure your signature on the account. You cannot own the account wholly. That disrupts the 1031 exchange, but you can certainly have signatory rights on the account, so those funds cannot move without your authorization. And then lastly, just make sure they're accessible. We all carry our cell phones. We answer phones, 24 hours a day, basically. So if you got a question on a Saturday, feel free to give us a ring. Give us a call. We can walk through it. So here's some common exchange issues. Number one, ownership issues. So who can do an exchange? Any entity can do an exchange. Corporations, partnerships, LLCs. So here's an example. Fred owns 25% of the DEFG partnership. They're now selling the building, and Fred wants to do an exchange. Can he do it? Unfortunately, the answer is no, because Fred owns 25% of the entity that owns the real estate. Now, if Fred and his partners own the property as a tenant in common, where Fred owns 25% of the undivided interest in the real estate, then Fred could do an exchange on his 25% and roll out. And they're going to,
Drew?
attack. Yes.
In that situation, either at what interval in advance of the sale could Fred have bought out the other partners and then kept the entity and done the exchange, and or they could do a 1031 collectively? If the new deal created enough cash, could he then buy out his partners after the 1031 exchange?
Excellent questions. So the first one would be, we would suggest at least a year in advance. So there's a couple different ways you can do it. You could have, Fred could buy out the rest of the partnership and own the whole thing, and then the partnership could do the exchange. They could do a dissolution of the partnership and then transfer it into tenant in common structure. They could all decide to stay together, do the exchange like you mentioned, and then Fred buy them out. But once again, what is your intent? If they dissolve the LLC or the partnership, 5 days before the closing of their property, the IRS is most likely going to come back and say it's not going to qualify for exchange purposes because the entity owned the property for the last X amount of years, but now the 4 partners have only owned it for 5 days. Back kind of to our Fred and Sue example of putting Fred on the title right away. Now I will say there are ways to work through this. There's the drop and swap, which is like what I just described, where you drop out of the partnership in the tenant common and then you each do an exchange. These are pretty high level type of structures that we want to consult with clients, probably bring in their tax advisors. We just did a transaction very similar to this on a large commercial building in Denver. There was just two partners, and they ended up dissolving the entity, taking their interest 50-50. One did exchange and one didn't. For this simple example, we were trying to keep it real basic and just basically say, hey, if he owns 25% of the partnership that owns a property, he couldn't do an exchange. Trust can certainly do an exchange. Where you run into issues with a lot of these, if you own properties in an LLC or partnership or trust, typically is on the back end when you're going to buy your new property, and you've got financing issues. Lenders tend to like to loan to individuals on smaller properties. Obviously, if you're doing much bigger properties, you have it in an LLC, but that tends to be where we see most of the issues. Tenancy, joint tenants in common, can all do exchanges. Again, joint tenants, community property, tenants in common, divorce issues. Like my dad says, if you have a divorce, you have issues. But we do a lot of these where, Fred and Sue have owned this property, they're now getting divorced, and Sue wants to exchange out, and Fred wants to take his money. They can certainly do that. Sue would do an exchange on her 50%. Fred would take his 50% and pay the tax. Foreign owners, this gets quite a bit more sticky. There's what's called FIRPTA, which is the Foreign Investor Real Estate Tax Act. And if you have questions, I won't dive into it real deep here, but if you have questions on it, feel free to give us a call because there are a lot more rules that you have to abide by if you are a foreign owner and doing a 1031 exchange. Some more exchange issues: owner carry notes, contract for deeds, installment notes. In a 1031 exchange, if you have a note, or, if you're selling the property, you say until the buyer will be willing to carry back a note, you can still do a 1031 exchange, but it definitely makes it a little bit more difficult in order to do that. Okay, taking money out. Oftentimes we get the question of, well, I want to sell this $100,000 property, but I'd really like to take $5,000 out of it to go on a vacation. Can I do that? The answer is yes, but that $5,000 is going to be taxable too. So in our scenario, the $100,000, Jim takes $5,000 to take his wife to Mexico, and he does an exchange on the balance of it. That's just called a partial exchange, where he's recognized some of the tax. Oftentimes we get questions of, well, that $5,000 is my original investment that I put in the property when I bought it. Doesn't that mean I should be able to get that back? And unfortunately, the answer is no. The IRS says the first dollar out of a 1031 exchange, they're going to get their tax on before you can get your money back. So the IRS calls that taking money out of an exchange boot. Timing issues of taking money out. I'm just going to keep going back to Jim's example here. If Jim sells his property, the $50,000 comes into his exchange account, and he calls us up 3 days later and says, hey, I'd like to take $5,000 out. Unfortunately, he cannot do that. You have to take that money out at the time of sale. So again, forethought planning really comes into play. If you know you want to take some money out, you just need to let us know. We can adjust the documents to reflect that, and you use the funds at one time. Taxability issues. Those are going to be taxable to you. There's no way around that. We've had numerous discussions with clients who argue otherwise, but at the end of the day, you're going to pay taxable money that you pull out. Impact on the exchange. It's also going to lower his reinvestment goal. So instead of having to reinvest the $100,000, Jim would have to just reinvest the $95,000 because he's recognized the gain on that $5,000. So that's how it would impact the balance of his exchange. Consolidation exchanges. Back to the question that we had earlier: selling multiple properties and rolling into one. The issues that creates are basically timing issues. The reason being is because of our 45 and 180 day deadlines. So let's say, for example, you're going to sell 3 properties and roll into one. The timing on the sale of the first property, even though each one is going to have their own 45 and 180 day time frames, your first one's going to basically be your trigger, and you're going to have to get everything done based on the first sale's 45 and 180 day time frames, because you cannot take the money from the first sale, buy the new property, and then take the other 2 and roll it into after you have already purchased the property. The IRS does not allow you to use 1031 funds into something that you already own. So you have to make sure you get all 3 of those sold before you need to roll into a new one. I think our record is, I think the gentleman sold 12 properties and rolled into one. And he, again, had a lot of foresight, a lot of planning to make this happen. It can be done. Typically we see a lot, 2 or 3 into one is pretty common. But it can certainly be done, but the timing is the biggest hurdle when doing that. Diversification exchanges, just go in the opposite direction. You kind of feel like you got all your eggs in this one apartment building, you want to sell it off and go buy 3 or 4 of the properties. That's a much easier transaction as long as you can find your replacement properties. And again, you just need to identify within the 45 days purchased within the 180. Looking at retirement needs, this is where Dave and Kira really come into play with what I basically call institutional investors. Dave and Kira are institutional investors. They're finding large, high cash flowing properties that you can roll into, 1031 into, or just buy into, and it's, for lack of a better term, we kind of call it mailbox money. There's no management as an individual. Dave and Kira take that on. And we're seeing a lot of clients who have had, a portfolio of rentals, who, as Kira talked about earlier, are just tired of fixing leaky roofs and dealing with tenants, and they can roll out of their appreciated real estate into something that is professionally managed, and they're just going to get a check in the mail every month, and nobody has their cell phone to call them on a Sunday at 2 in the afternoon. Maximizing investment yield. This one, we're seeing a lot of people, especially here in Denver, where we've had a huge appreciation over the last couple of years. I'm guilty of this as well. I've got rentals where if I look at my yield on what I paid for it, it's great. But if I look at my return on equity, it's not that good. And so we have a lot of people saying, hey, I'm gonna take this equity and go find something that it may have a lesser return on paper, but they're going to get a much better, check in the mail because the return on equity is going to be much better than they were getting before. Integrating with estate planning.
Drew,
yes,
Drew,
sir.
Can we pop in with a question real quick?
Please.
So I would identify the new property, get a closing date out several months, and then list, sell, and close out the old properties before closing on the new one? Question mark.
Yes, in a straight exchange, that is correct. There is an avenue in which to buy the new property before you've sold the old property, and that's called a reverse exchange. And once again, we'll get to that here in just a second. I'll kind of breeze through this one really quick, but basically integrating 1031 exchanges with your estate planning. Here's a perfect example. We had a client that was a farmer. He had a huge amount of farmland out in, I forget, Kansas or Nebraska, and he ended up selling that farmland off and went and bought properties where each of his 3 children lived. So I think he had children like Boston, Texas, and Colorado. And so he ended up buying his replacement properties in 3 areas. And his intent was, when he passed, he would just have those kids inherit each one of those properties. So when he went out and found his replacement properties, his kids were very involved, and they said, hey, I'd like this townhome in Boston, I like these single families down in Texas, and I like this duplex in Colorado. He then rolled into those in a 1031 exchange. He took the cash flow from them. Kids helped manage them. And then, upon his passing, kids took it over. They get a step up in what's called step up in basis, and meaning that they get it at the value of the day of dad's death, not at dad's value. They take over the property. At that point in time, they could sell it, cash it out, continue to rent it, etc. So this is a real life example. We had a client do exactly this structure. So, Dave, jump into that question. Advanced exchange techniques, a reverse exchange. What we've been talking about all previous is a straight exchange. Selling the old property, buying the new property in that order. Reverse exchanges are when you need to buy the new property before you sell the old property. But as you may remember, I said you cannot use 1031 funds into something that you already own. So you cannot buy the new property and then sell an old one and roll into it. What happens in a reverse exchange is we, as the qualified intermediary, actually buy the new property on your behalf and park that property for you. Then you can sell the old property and roll into it. That's a real basic example of how that works. Reverse exchanges are much more sophisticated because there's a lot more moving parts. You've got to figure out how to fund the purchase of the new property. So either A, the client has to have the cash to loan to us to buy the property, or they have to be working with a lender that understands how the transactions work and is willing to loan to an entity of which they don't own ownership. So to answer the person's questions, it can be done, but I'd walk you through a little bit better on how that works, because they are a sophisticated transaction. Construction exchanges, you sell a loan property and you want to build an industrial building to run your fabrication business out of it. It can be done as well. It's very similar to a reverse exchange in that we actually take title to the new property. We make the improvements using the money from the client, and then once the property is built, then they complete their exchange, take ownership back of that property. Improvement exchanges, very similar to a construction exchange. You buy a building and you want to retrofit it. Same scenario. We take title, we make the improvements. We talked about integrating with estate planning. And that pretty much sums up the presentation. So let's open it up to questions, comments, discussion.
All right, we're caught up on questions as we went through. So, Kira, do you have anything to add? Give somebody a minute to collect their thoughts and see if we have any last questions before we wrap up.
Yeah, I'm just impressed you got that done in 40 minutes. I usually talk ad nauseum, so I'm sure the investors are appreciating your succinctness.
Well, thank you. I didn't want to. It's one of those things where you don't want to waste people's time, but there's a lot to cover as well. So here's our contact information. Please feel free to call us. We'd love to just talk to you directly. Email, whatever works. I want to respect people's time, realize everybody's busy. So if there's other questions or anything.
So I guess the one thing I'll kind of wrap up pointing out, we'd like to talk about our core values a lot, and you guys might hear from us a lot of the time about transparency and co-investment. And Drew and his team in these webinars, I think, are a great example of our value for value. The way Direct Source Wealth works is that we sort of trust the process and the people we work with. So, there's no direct compensation. We don't get any sort of, whatever spiff or points or fees or anything, if you work with Drew and his team. But we love making these introductions because when we find good quality, valuable people, that makes a contribution to you, our investor. And when it works and there's overlap in what we can contribute and do for you, we appreciate that you always think of us first when you have money to invest and questions or thoughts. But certainly there's going to be times where what your strategy is doesn't dovetail with what we have to offer, and we encourage you to reach out to our product partners directly and build relationships with them. These are people we work with and we appreciate, and we're happy to make these introductions, and hopefully you're experiencing that value contribution through this webinar and others like it. So keep coming back and participating. We'd love to have you.
And just to wrap it up on one last housekeeping item, first of all, thank you, Drew. Thank you, Kira, for another great session. And for all of those who have estates, who are using LLCs to create tax advantage strategies, and for planning minimal tax invasion for your real estate investing, please get on to directsourcewealth.com/events and sign up for next Tuesday's webinar with Matt Sorensen. Matt is a IRA and real estate specialist attorney. He calls himself the attorney for entrepreneurs, and he certainly lives up to his billing. And it's going to be a great webinar. There's a ton of great material on that. Whether or not you're exposed through your LLC or to your LLC is a key topic that a lot of people are not aware of, and there's just going to be a ton of great information conveyed. Matt's always a delight to work with, and we look forward to bringing you more of these top of their field presenters over the next few months. With that, I'm ready to wrap it up. Kira, any last comments?
Thank you very much.
Everybody have a fantastic week.